tonight I'm going to try to make a case for a penny stock, and I'm going to learn as I go and try to quantify a way of perhaps trading this. Okay, first I'm going to start with this quote right here. I was actually at a men's choir concert one time, and I was just meeting somebody, and we were talking, wanted to know about me, and I told him that I'm a stock trader. And he said this, which I thought was downright brilliant, especially this last part. He said, stock picking never clicked for me. He was a music major. He said, I always knew the best stocks. I always went through the accounting statements. I always went through the income sheets, but they never went up. He said, since we're at college, I'll use a drinking analogy. It's not about flirting with the prettiest girl in the room at the party. It's about flirting with a girl that everyone else thinks is pretty. So why do I think that's so brilliant? Well, think of it this way. In the dot-com bubble, like, is this Qualcomm? Yeah, in the dot-com bubble, what actually drove the stock up? Actually, we'll even go back further. What drives a stock up? Demand. It does not. The company, it doesn't matter at all. It's 100% demand. So if demand increases, then shortly after, the stock should also increase. So, like, take a look here. Like, I'm mainly talking about volume. Look at Qualcomm right here. I'm using the 20-year chart right now. Notice the volume. No volume, this stock is asleep. Higher volume, the stock starts to go up a little bit. It's still a penny stock. High volume, higher volume, and then a short little downswing, and then suddenly volume goes right through the roof. And at this point, Qualcomm, in the course of, let's see, 1999 to 2000, goes from 99 bucks to 90 bucks. I mean, 99 cents to 90 bucks. Wouldn't be nice to I mean, it would be nice to have a, let's see, 1,000%, no, we're talking about like 9,000% return. That would be very nice. And then, of course, they split after that. But what we're looking for is big buyers to stem demand. So like institutional transactions. I talked to a hedge fund manager, and actually, well, he did a lecture back at my school, Penn State, and he was saying something to always look for with a stock is volume accumulation. So he said, like, see if I could go to panel. Yeah, he was saying this stock right here, it came out with something new and awesome a while ago. It's basically like a new way of lighting television, so we don't have to have these big bulky TVs. He was actually talking about being able to build a television into a wall that is no more than a few centimeters thick and paper thin, like you could roll out a television paper. He was saying, well, you know, this stock really hasn't taken off, and he was putting on the institutional transactions with this, and like how many institutions were buying this stock. Suddenly, right in this area, institutions started snatching up this stock, and of course we see at that point that the volume also increased drastically as well. So if we jump to this 5-year chart, volume went up, the number of institutions that wanted to buy started to come in, and then of course the stock went down again. And then once again, if you see, there's even more accumulation now. So this might be another like Qualcomm situation. That'd be nice. Okay, so what I wanted to talk about was PPHM. They're a pharmaceutical company, and I noticed this sudden volume jump a little while ago. Okay, this stock has had a pretty miserable history, to be honest. Since its IPO in 2000, it went from, let's see, went from $10 up to $20, and now it's down at $1. Okay, so I don't like that so far. But I'm looking at, well, I'm looking at what it's doing right now, and at 104, it's at the 2008 recession support level, which, okay, that's a good thing. That means that there's a good chance that it's high probability that's going to bounce off this level at least once. But what I'm noticing is that, and you can use like things like I think I use Insider Cow to get institutional transactions and insider transactions. In the last few years, there have been institutional companies like BlackRock that have been buying up this stock, and we see that at this time there's also a volume is also picking up. So what would I do in this situation? Actually, I'll talk about trading next time. So we have this right now. So how can we quantify this? I was thinking of making a system like you see right here. There's a blue line and then there's a red line. The red line is the 30-day exponential moving average. That's going to place more weight on the most recent data and less on the less recent data. And then this blue line is the linear regression. It's the linear regression line. What I want to do is actually quantify, like if we take the slope of that line, so linear regression slope, and we'll make the source off of the volume, and I'm using monthly chart because I'm being long term here, and we use the 48 month, which will represent one complete business cycle. And I see this and I think, okay, I really like what I see. The slope of the linear regression channel for the past 4 years is just going up, up, and off the chart, basically showing that we're getting tons and tons and tons of accumulation, or at least tons of demand. So this stock might be, it feels like this Peregrine Pharmaceuticals, with that and the combination of institutional transactions, people buying it up, and even insiders buying it up, it looks like a good thing. So what does Peregrine do? It's a symbol PPHM. I was looking at a couple of their things. They work with a lot of anti-cancer, antiviral technology, and what's really cool about that, they have a special targeting mechanism. So like, say that this is a brain tumor, we could say that traditional radiation therapy might put radiation in the whole body. The way that this works is that the drug attacks only the tumor in the brain, and there's minimal, if any, radiation anywhere else. Okay, so I was looking at this and I was saying, okay, what does this treat? It treats this, I don't know how to pronounce that, but it's the deadliest form of brain cancer. The survival rates of this near around 3%, and that's within 6 months. Take a look at this right here. In their phase 2 trials, so this is something that's going to happen in the future. The approval, they still have to do phase 3. But if this does get approved, take a look at these results. The average survival rate was 9.3 months. Okay, that's not bad. And of course, this gives us even better statistics. So those alive at 6 months, 73% of the patients, 12 months, 38%, 2 years, 19%, and then 2 patients out of these 40 patients, which is about 5%. Yeah, just about 5%. 5% went 3 years and still stayed alive. So I'm thinking, if this can keep somebody alive for another year if they have brain cancer, yeah, that could definitely be workable. And you know, even though this is in phase 2, they could always improve it and make it perhaps even better. So I'm liking what I'm seeing right here, and I'm especially liking that this whole volume thing, people are accumulating this stock. So how would I trade this? Okay, so I'm not going to promise any miracles here. It's imperative that we do some risk management, and we believe that this is going to be a long-term process. So what would I do? Okay, PPHM, let's say analyze PPHM, add simulated trades. We'll buy the stock at 104, and then I see this July option. We'll sell a covered call on it. So sell a covered call for 20 cents. Hopefully we'll be able to get in there. So 20-cent covered call, and you can do this as many times as you want. So what does that mean? That means that we have now protected ourselves from 20% downside, or 20 cents downside. That's pretty good. These premiums are wild. 20% protection to the downside. that's definitely good. And to the upside, our potential is making 166 bucks, which is, since the strike price is 250, that's where our profits are capped off. So 166 bucks for everything that we do on this. So our maximum gain, 166 bucks. If the stock goes to zero, our maximum loss is about 75, and that's like complete bankruptcy. So risk reward ratio is only about actually for this it's about 2.2, and we know, well, with good certainty we know this isn't going to go to zero, or at least in the next 6 months. So just some thoughts. Please, if you have any input, jump in. I'm just trying to come up with a good situation here, a good strategy to take advantage of this institutional accumulation. Alright, thanks for watching.